Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello everyone, we are back again talking about the next topic in our podcast series.
Yeah, next topic in the podcast series is all about getting your debt under control.
Very exciting, very exciting. I can hear the eyeballs rolling back in people's heads now, but once again, imperative part of the strategy, and if you can manage to nail this will make life a hell of a lot easier from a wealth creation journey and a financial freedom perspective. With some careful planning, it's not that hard to achieve. It seems like a big task, but like anything, how do you eat an elephant? With one bite at a time, and before you know it, you're making progress.
Yeah, absolutely. And I guess the first point in call, once you start sort of talking about debt, is really getting an understanding of what good debt is, what bad debt is, because there are different types of debt. So yeah, Billy, run us through it. What's the difference between good and bad debt? And is there even a thing as good debt? Is that just a myth?
Well, look, the term comes up to, in terms of good debt, it's being interest that you're paying on. Good debt is the debt or the interest that you can claim as a tax deduction. So think about it as a productive debt. Think about it as, the debt that you've got on an investment property where you're paying a loan off, whatever the interest component of that loan is, you can claim that as a tax deduction, and therefore it gets termed as a good debt because it does help with a wealth creation perspective. But then again, there's also the other flip side of that, which you alluded to, Andrew, is any debt good debt? Because having debt ordinarily is one of those things that over time we try and expunge. But in saying that, and as we work our way through the podcast series, you will recognize that from a wealth creation perspective, debt gives you the ability to be able to leverage and enhance and accelerate your wealth creation journey. So as long as you're using debt with care, with skill, and respectfully, you can use it to your advantage. So from a good debt perspective, it's really being able to claim the interest as tax deductible, whereas bad debt is interest that you've got or interest that you're paying on a loan, you can't claim as a tax deduction. So there's no benefit in having bad debt. In saying that, the main bad debt we're all familiar with is having the debt on your owner-occupier. Unfortunately, that's just a necessary part of life and we really can't do much about it. We'll talk a little bit about paying off your mortgage and how do you focus on that shortly. But yeah, that's really the difference between good debt and bad debt.
Yeah, so good debt's really the things that are helping grow your wealth. So any debt that's really helping grow and expand your wealth to a faster extent, then that's good debt. And bad debt is all of those things that are really lumped and spoken about, and you might even have heard the term that's coined, and that's consumer debt. It's sort of the big thing that most people tend to struggle with, especially initially. And they're your credit cards, your personal loans, all of those really horrible things that, I don't know about you, Billy, but if I could click my fingers and all of them were to go away, I think the benefits of getting rid of that asset or that sector as a whole would far outweigh any of the costs.
Tend to agree, but I'm sure that sector that benefits from that tends to disagree. The other big one in that category as well is the buy now, pay later category that we've seen sort of come out of nowhere. Think of your afterpays of the world, that sort of falls into. But ultimately, your consumer debt is taking on debt to buy things for you to consume. You really want to try and avoid that as best as you possibly can because that's a downward spiral. And before you know it, you've got all of these goods that get to scratch that itch by being able to buy the latest gadget or the latest clothes or whatever it may be. But then paying back that debt and getting that monkey off your back tends to take a little bit of time as well too. These seem to be the ones that attract a higher interest rate as well too. So if you don't pay it back within a certain period of time, it does cost you financially quite substantially. And if you're not disciplined and you don't have that under control, it can get out of control very, very quickly. So from our perspective, it's something that we tend to avoid as best as possible. And if we do have any consumer debt with people that we are talking to, that's the debt that we concentrate on first because we want to get rid of that as best as we possibly can because it does spiral out of control and it can create some issues from a cash flow perspective and really derail someone's financial well-being as well too.
Yeah, that's a good point, Billy, and sort of take us through that a little bit more. I mean, those that do already have some debt out there, and there's some pretty scary statistics in terms of how much people hold in terms of consumer debt. How do you go about it? What do you start, or what do you recommend to your clients? What's the best way to start knocking off that consumer debt and get through it a bit quicker?
So look, there's a couple of ways to do it. I mean, the first thing, which is fairly obvious, but it doesn't really get enough attention. But the first thing is, if you are partaking in that particular behavior where you are going to the shops and you're putting something on your credit card, or you're using Afterpay, or any of those other things that we spoke about, the first step is you need to stop. That's kind of the first thing. And the first thing that you do is you stop digging, right? So that's pretty straightforward, but it gets overlooked. From that perspective, once we have stopped that behavior and we've identified that we want to work on that and get out of it, there's really two things that you can do in order to pay down those debts. And you may have heard the terms before. It's a debt avalanche versus a debt snowball. I'll just run through what the two are. Debt avalanche is basically you're paying the highest interest, whatever's attracting the highest rate of interest, that's what you're focusing your time and attention on. In saying that, with all of these, you want to be meeting your minimum repayment commitments right across the board. But the debt avalanche, so once you're meeting your minimum repayments, you are then focusing any surplus that you've got on the debt that's attracting the highest interest rate first. That will, over time, that strategy there is designed to pay the least amount of interest as you possibly can. Versus the debt snowball. And what that is, this is a bit of a different approach, but the idea is you're trying to get rid of your debts with the smallest amount of debt first, so the one that you owe the least amount on. And the idea behind this is more psychological than anything, is like a snowball, it starts off small and it tends to get bigger and bigger and gets more momentum as it goes. The idea behind this is if you start knocking off those smaller debts, you start to get some momentum, you start to get some confidence, and you tend to move faster through repaying back your consumer debt that you've got. So they're really the two approaches that we've got. There's no right or wrong. I mean, mathematically, it makes sense to pay the highest amount of interest first because that will cost you the least amount of money. But in saying that, from a psychological perspective, and depending on how long this has been present in a person's life, the debt snowball method could be a better way of doing it, because we do get that momentum and you do start to get some wins on the board. You're feeling a lot more confident and you're more engaged in that process. So there's no right or wrong. Ultimately, what you want to do is you want to get out of consumer debt and you want to stop attracting consumer debt as soon as you identify that and start this process.
Yeah, absolutely. Absolutely. And I think that's a really important term. I mean, or really sort of important balancing act that we as financial advisors sort of talk to our clients about all the time. There's no one way to do things. And just because it makes sense financially to pay off your highest debt first, if it makes you sleep easier at night, if you feel more confident, if you feel better about not having 3 credit cards that you're owing money on and only having 1, then absolutely pay down the smallest debt first and utilize the debt snowball strategy. That's perfectly fine. There's always a bit of a balancing act between the right thing to do financially and the thing that helps you sleep easier at night and makes you feel more comfortable. So no right or wrong. I guess we're pretty happy as long as you're paying down that consumer debt as quickly as possible, irrespective of which methodology or sort of what process you follow. As long as that's coming down and as long as you're making sure that you're consistently doing that, which I guess is sort of the other thing with it is, in the last podcast, we spoke about a bucketing strategy. So we spoke about direct debit your bills. Make sure that you're putting money towards bills on a regular basis and that you're accounting for that in your budget and in your surplus income. Paying down debts, that is absolutely one of those bills.
Yeah, you're absolutely right, Andrew, because the system doesn't work unless you've got these out of the way. And that can take a short period of time, depending on how much debt you've got, or it can take a long period of time. So going back to that strategy, identifying the surplus, trapping that surplus and doing something with it, we'll use the doing something with it to pay off the consumer debt before we do those other things that we were talking about, like building the emergency fund and start saving and investing. The easiest way, which is what you just alluded to, is setting that up as a direct debit. So you treat it like an expense and you really set yourself a goal and a target. You reverse engineer it and say, this is the amount of surplus that I've got. This is the amount of debt that I've got. If I'm paying back X amount each week, fortnight, month, whatever your cycle frequency may be, that's what you do. That's how you set it for yourself. And you know that in X amount of time, you're going to be rid of your consumer debt. And then you can move on to deploying that money into building your emergency fund and then saving or investing it.
Yeah, absolutely. Absolutely. And I guess one of the other ways or one of the other things that you can do to help reduce or help reduce the time frame that you're paying down that debt is looking at debt consolidation. So there's plenty of offers out there and there's plenty of different products out there that will offer this ability. And having the ability to consolidate all of your debts into one spot can make it significantly easier to manage. It's far more convenient, it's far more visible. And in addition to that, taking advantage of some of those interest-free terms that are available.
Yeah, I mean, pretty straightforward. I think from a convenience perspective, it kind of makes sense rather than making a whole heap of small payments to a whole heap of different providers that you've got debt with. If you bring it all under the one umbrella, it's easier making one repayment. Just from a convenience perspective, from a visibility point of view too, it makes it a lot easier to be able to see where it's going because it's one payment out. If you manage to get a cheaper interest rate, that's even better. I guess the only thing that you need to be mindful of, and where we see people get caught out, is if you're taking something that's short-term in nature and you're consolidating that into something that's longer-term. So the easiest way is thinking of this, maybe taking a credit card debt and rather than paying 19% on that, which is never a good idea, rolling that into your home loan and say your interest rate is 3%. Obviously, the interest rate differential is substantial, but you've then converted a short-term debt into a potential 30-year loan term by just adding it there. So that's something that you need to be mindful of as well, that if you are doing that, that you're still paying that off in whatever period of time that is, because you don't want to convert the short-term debt into a longer-term debt, because if you do, it may end up in certain circumstances that you actually end up paying more in interest, even though the interest rate is substantially less than what you're paying as it currently stands. So that's just something that you need to be careful around debt consolidation piece. But we've seen debt consolidation work successfully, and if you've got some discipline around it, it's a worthwhile strategy that people can deploy to help get their finances under control.
And look, don't want to go sort of too much into it or anything either, but just being careful and conscious around the fact of doing it too many times can impact your credit rating and all of that. So make sure that you are receiving some advice behind what you're doing and making sure that it's not going to impact your credit rating or anything by constantly rolling and moving debt on.
One of the things that we talk to people about all the time too is paying down their owner-occupier debt versus their investment debt. I mean, that's pretty straightforward. We sort of go back to that piece that we spoke about at the start about good debt versus bad debt. The investment debt that you've got, say it's the mortgage that you've got on an investment property, that is the interest that you're paying on that is tax deductible. So what we want to do from that perspective is we want to make sure that we don't pay that down as quickly as we can, because we want to divert the money that we can pay down towards our owner-occupier debt. So that's something that we talk to people about all the time from that perspective as well too.
Yeah, absolutely. Absolutely. It's sort of a pretty easy one to miss and a pretty easy one to forget about, and making sure that you're first paying down the debt that you can't claim a tax deduction on, which for most people is, that owner-occupied debt, before you start paying down the investment property. If you're reducing your expenses and you're reducing your debt, it is only a good thing. There's better and there's good.
No, hit the nail on the head there, Andrew. Absolutely. And we spoke about the benefits of what good debt can have on an investment strategy. So we might just unpack that a little bit more, just to put some numbers and some context around what that looks like. Because when we're talking to people about wealth creation, the thing that we often speak about is being able to use leverage to help accelerate that position as well. So depending on somebody's circumstances, if the strategy fits, if the client's circumstances dictate, we may be in a position to borrow in order to invest into a particular asset. Andrew, from a numbers perspective, what does that look like?
Yeah, I mean, look, debt can be a very powerful thing. Don't want to sort of make this all doom and gloom and just say, don't take on any debt, because if that's the case, there's going to be very few people, especially in Melbourne, that are going to be able to buy a car spot, let alone a property to live in. So you're going to have to, or most people are going to have to at some point, utilize debt in order to help accelerate, whether that be getting into the property market or whether that be accelerating their wealth creation. And debt can be a very powerful tool from a wealth creation perspective, and provided that it's utilized with care, it can really help accelerate growing your wealth. And sort of one of the best examples sort of behind this is having an amount of money to invest. The amount of money that you're investing is limited by the amount of money that you have. And let's sort of put some context around it. Like If you've got $50,000 and you invest that $50,000 in whatever it is that your investment strategy is designed to invest in, you've only got exposure to the amount of money that you're investing. Whereas utilizing debt when you're investing can mean that with $50,000, you've got exposure to an asset class that's worth hundreds of thousands of dollars. So having the ability to utilize debt in that manner and utilizing that in the right way with some risk mitigation strategies in place can really help accelerate your wealth creation. Granted that obviously you need to be aware that if you're utilizing debt to invest, it's magnifying your gains, but at the same time, it can magnify losses and increase risk in a portfolio. So making sure that there's some risk mitigations there is absolutely imperative.
Yeah, like anything. I mean, if you treat it with respect and you do it carefully and there's some good strategies behind it, it can work. I mean, from a high level numbers perspective, we're quite fortunate at the moment that from a borrowing potential or from a rate perspective, we can borrow money at the moment with a 2 in front of it, depending on what you're borrowing against. But if you're borrowing money at, say, 3% and you're investing that money into an asset that's generating a rate of return of 10%, you've got a 7% gain essentially, and we'll put the tax and the deductibility and everything aside. But high level numbers, you're borrowing at 3, you're getting a 10% rate of return. So your net gain is 7%. That can be extremely powerful, and especially in a low interest rate environment, and especially in an environment where we're seeing growth assets continue to increase. Specifically in Australia, we've seen the property market go from strength to strength, even though we've gone through COVID and we were expecting, well, the commentators were saying that the opposite was going to happen. Property market has proved to be extremely resilient. But if you look at it from that perspective, borrowing at 3, getting a 10% rate of return is an absolute no-brainer. As long as you've got the right risk mitigation strategies, as long as you're borrowing conservatively enough. Andrew, I couldn't get that one out. I couldn't get that out. I think I need another coffee. And as long as you are buying good quality assets, they're the things that you do to try and ensure that you are doing it properly and conservatively, and making sure that you've got good exit strategies, which we will do a deeper dive later in the series as well too, to unpack that a little bit more, to give people some more context around the things that we're talking about. But from that perspective, kind of a no-brainer, and it kind of, that's how it's done. That's how people grow their wealth, is through leverage. And if you're not taking on debt, we're not encouraging it by any means, but if it suits, it's a really worthwhile strategy to be able to deploy, to be able to grow your wealth.
Yeah, absolutely. Absolutely. As we said, really powerful tool, provided that it's used with care and provided that whatever debt you're taking on, you're making sure that there's some strategies in place that if things don't go to plan, if rental income doesn't come in for a period of time, there's enough surplus and enough cash flow in order to manage it. Provided that all of that matches up, really powerful tool. And I'm sure that we'll have another podcast at some point talking about utilizing debt to invest and utilizing debt to grow your wealth, and other things like a debt recycling strategy that can really help even use debt to pay down debt faster, which sounds really weird and kind of convoluted, but there's some really powerful ways to utilize debt to grow your wealth, and provided that it's done correctly and provided it's done with care, can be fantastic method to grow your wealth.
Yeah, we'll unpack that one. That's a bit more of an advanced strategy, but that is one that can really put your wealth creation journey essentially on steroids, and it tends to hit home with paying down your mortgage.
Yeah.
Most people, that's the thing that keeps them up at night, is the mortgage, because you're making these repayments for 30 years. You make a repayment month in, month out, and the amount outstanding doesn't really go down by that much, but there are strategies that you can deploy. Like I said, we'll do that. We'll unpack that and go through that in a little bit more detail in one of the other podcasts that we do, and concentrate directly on debt recycling. But I think that's about it for getting your debt under control. Andrew?
Yeah, absolutely. Absolutely. I think really the key takeouts out of that is, if you can avoid getting into that bad debt and that consumer debt, a preventative measure is always the best cure. But if you are in that situation, pay down your consumer debt as quickly as possible, minimize the amount of consumer debt that you take on in addition, whether you utilize debt avalanche or a debt snowball strategy, whatever it is that works best for you, make sure that you're paying that down on a consistent basis, and make sure that you're really sort of knocking out that bad debt before you start paying down that good debt.
Well summarised, Andrew. So, folks, that's about it from our end in relation to getting your debt under control. I hope you guys enjoyed listening to our podcast and you got a bit out of it.
Yeah, thanks very much, guys. Appreciate it.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.